How Inflation Swindles the Equity Investor. That was the title of a Time article written in 1977 by none other than Warren Buffett. It was an article designed to explain the impact that inflation had on stock market investors, on equity investors, people who had ownership stakes either in public or private companies. And at a time where US inflation is now at 8.6%, I can't really think of a better time to revisit this article from Warren Buffett. Back in 1977, when Buffett wrote that article, he was trying to explain a topic that was really imperfectly understood by the average investor. And if you're like me and have never really invested through periods of very high inflation, I think this is a great article to check out. So in this video, I'm going to go through my personal highlights from reading through this 1977 article from Warren Buffett, How Inflation Swindles the Equity Investor. If you enjoy the video, be sure to hit like and also subscribe to the channel if you are new here. But for now, let's get straight into it. Buffett begins this article by explaining that inflation is clearly very bad for asset classes like bonds. He says, when the value of the dollar deteriorates month after month, a security with income and principal payments denominated in those dollars isn't going to be a big winner. You hardly need a PhD in economics to figure that one out. And for a long time, investors in stocks, unlike investors in bonds, viewed their assets quite differently and thought that they might actually have some underlying protection from inflation. The general consensus, Buffett says, was that stocks are not claims against dollars as bonds are, but represent ownership of companies with productive facilities. Buffett then goes on to say that he believes that stocks in economic substance are really very similar to bonds. And many investors will be surprised to hear Buffett say something like that, because a bond, unlike a stock, has a very predictable return. It has a coupon printed on it which describes the annual rate of interest that a bondholder will receive from their bond investment, whereas stocks, particularly if you look at individual companies, the earnings can be very, very volatile, and it's sort of the job of the investment analyst, as Buffett has always said, to understand what you think those earnings and cash flows are going to be from a business that you're looking to invest in. And that is certainly the case from individual company to individual company. The earnings are very volatile, and the return that you can get as a shareholder can be very volatile year to year as well. But Buffett makes the argument that in aggregate, the returns on equity in stocks have in fact not varied much at all. He compares a few different time periods for businesses that trade in the stock market and analyzes their return on equity. And although there is some variation, he says that in aggregate over the years, the return on book value tends to keep coming back to a level around 12%. It shows no signs of exceeding that level significantly in inflationary years or in years of stable prices for that matter. So yes, although you can look at one individual company and see the earnings move up and down a lot from year to year, Buffett's making this argument that in aggregate, when you look at stocks as a general basket, the returns on equity are actually remarkably stable. But there are a couple of characteristics where stocks and bonds vary. He says it is also true in the real world, investors in stocks don't usually get to buy at book value. Sometimes they've been able to buy in at book value, usually, however, they've had to pay more than book value. He says that the key point here is that as inflation has increased, the return on equity capital has not. In other words, if you're an investor buying a basket of stocks that are earning about 12% a year in terms of their return on equity, and you pay about 1 times book value, you can probably expect to earn about 12% per year returns. Yet, during periods of inflation, let's say that inflation is 6%, stocks can't necessarily increase their return on equity to give you the same real return. In that case, they would have to lift their return on equity from 12% to 18% to give you the same real return, i.e. adjusted for inflation. He says eventually the bond investor gets to renegotiate the terms of his contract. Stocks, on the other hand, are perpetual. They have a maturity date of infinity. Investors in stocks are stuck with whatever return corporate America happens to earn. If corporate America is destined to earn 12%, then that is the level investors must learn to live with. Individual companies can be sold or liquidated, and corporations can repurchase their own shares On balance, however, new equity flotations and retained earnings guarantee that the equity capital locked up in the corporate system will increase. So, score 1 for the bond form. Bond coupons eventually will be renegotiated, equity coupons won't. It is true, of course, that for a long time a 12% coupon did not appear in need of a whole lot of correction. So here, Buffett is making the argument that if inflation is very high and you're a bond investor, eventually your bonds will mature, you'll get your capital back, and you'll be able to purchase into a new bond. And at that point in time, bond investors are likely to demand a higher coupon, a higher return if inflation is very high. Whereas stock investors, the return that you get from stocks is perpetual. There is no maturity date on a stock, and you don't get to renegotiate that coupon or that return like you might be able to with a bond. So you really are stuck with that approximately 12% return on equity, at least at the time of writing this article, that corporate America was generating. There is also one other key difference with a stock versus a bond, which is that the bondholder gets all of their return in cash, whereas a stockholder may get some of their return in cash through things like a dividend payment, but they will also get some of their return through reinvestment internally within the business, which generally will lead to a capital gain or appreciation in the stock price, assuming that the company is retaining that capital and investing it intelligently. He says that, in other words, going back to our corporate universe, part of the 12% earned annually is paid out as dividends, and the balance is put right back into the universe to earn 12% also. The reinvestment part of the coupon can be good or bad news, depending on the relative attractiveness of that 12%. He uses the example of the 1950s and 60s and said that stock prices in this period ranged far above book value. You can't pay far above par for a 12% bond and earn 12% for yourself. But on their retained earnings, investors could earn 12%. And at that time, 12% was very good. The 1950s and 60s were an environment in which interest rates were very low, and 12% was a phenomenal return compared to what you could get in bonds. Again, a lot of similarities probably to what we've seen in the last decade here in the 2010s and 2020s. So he goes on to say that it was a situation that left very little to be said for cash dividends and a lot to be said for earnings retention. Indeed, the more money that investors thought likely to be reinvested at the 12% rate, the more valuable they considered their reinvestment privilege, and the more they were willing to pay for it. If during this period a high-grade, non-callable long-term bond with a 12% coupon had existed, it would have sold far above par, and if it were a bond with a further unusual characteristic, which was most of the coupon payments could be automatically reinvested at par in similar bonds, the issue would have commanded an even greater premium. In essence, growth stocks retaining most of their earnings represented just such a security. When the reinvestment rate on added equity capital was 12%, while interest rates were generally around 4%, investors became very happy, and of course, they paid happy prices. And just to close out this argument from Buffett that in many ways stocks are quite similar to bonds, he has this section in the article called Heading for the Exits, which is basically when interest rates started to rise. He said, and as long-term corporate bond rates began moving up, eventually reaching the 10% area, both the return on equity of 12% and the reinvestment privilege began to look different. Because of the additional risk, the natural reaction of investors is to expect an equity return that is comfortably above the bond return. And 12% on equity versus, say, 10% on bonds issued by the same corporate universe does not seem to qualify as comfortable. As the spread narrows, equity investors start to look for the exits. So as you can hear from Buffett in this comparison between stocks and bonds, there are some key differences between those two asset classes, but the thing that's really holding stocks back from being a truly good inflation hedge is that they really will struggle to increase their return on equity up from that circa 12% kind of figure that they seem to keep coming back to at the periods that Buffett had looked at. And Buffett actually goes through and lays out 5 ways in which companies actually can increase their return on equity. So if you're looking to invest more in individual companies and you want to understand how they might perform during inflation, ideally they want to be able to take advantage of at least one of these 5 ways in which you can increase return on equity to give the same real return to shareholders through periods of high inflation. So those 5 methods are an increase in turnover, i.e. the ratio between sales and total assets employed in the business. Number 2, you have cheaper leverage. Number 3, you have more leverage. Number 4, we want lower income taxes. And number 5 is wider operating margins on sales. He says, and that's it. There simply are no other ways to increase returns on common equity. And working through these 5, Buffett is actually fairly pessimistic around the average business being able to take advantage of one of these 5 ways of increasing their return on equity. When referring to option 1, an increase in turnover, he says, assuming a constant rate of inflation, sales and fixed assets will then begin to rise in concert at the rate of inflation. He says the gains are going to be modest at best in that department. In terms of cheaper leverage, highly unlikely. You have to remember that the typical way in which central banks try to stop high levels of inflation is they put interest rates up, which is the exact opposite of cheaper leverage. So probably not particularly likely to make much ground on that one. Option number 3 is more leverage. Again, probably unlikely given that interest rates are going up and leverage is becoming increasingly expensive. Next on the list, we had lower corporate income taxes, and there's obviously not much that the typical business can do about that. But Buffett basically says that investors in American corporations already own what might be thought of as a Class D stock. He's making the argument here basically that the US government are already shareholders in the business. They get a portion of corporate earnings from corporate income taxes. He says it's true that these investors have no claim on the corporation's assets. However, they get a major share of the earnings, including earnings generated by the equity buildup resulting from retention of part of the earnings owned by the Class D shareholders. A further charming characteristic of these wonderful Class A, B, and C stocks is that their share of the corporation's earnings can be increased immediately, abundantly, and without payment by a unilateral vote of any one of the stockholder classes, e.g., by congressional action in the case of the Class A. Whenever the Class A, B, or C stockholder vote themselves a larger share of the business, the portion remaining for the Class D, that's one held by the ordinary investor, declines. So that really leaves us with only option number 5, which is an increase in operating margins, wider operating margins. He says the last of our 5 possible sources of increased returns on equity is wider operating margins on sales. Here is where some optimists would hope to achieve major gains. There is no proof that they are wrong, but there are only 100 cents on the sale dollar and a lot of demands on that dollar before we get to the residual pre-tax profits. The major claimants are labor, raw materials, energy, and various non-income taxes. The relative importance of these costs hardly seem likely to decline during an age of inflation. Recent statistical evidence, furthermore, does not inspire confidence in the proposition that margins will widen in a period of inflation. In the decade ending in 1975, a period of relatively low inflation, the universe of manufacturing companies reported on quarterly by the FTC had an annual average pre-tax margin on sales of 8.6%. In the decade ending 1975, the average margin was 8%. Margins were down, in other words, despite a very considerable increase in the inflation rate. And of course, Buffett has talked for years about certain businesses that do have pricing power and do have the ability to increase operating margins. See's Candy, Coca-Cola, Apple, Moody's. These are all examples of companies that Buffett has invested in that actually do have this characteristic of being able to increase operating margins over time. But again, if you were to look at American business in aggregate, there really doesn't seem to be a huge amount of room to move. So Buffett goes on to say, there you have your complete lineup. 5 factors that can improve returns on common equity, none of which, by my analysis, are likely to take us very far in that direction in periods of high inflation. You may have emerged from this exercise more optimistic than I am, but remember, returns in the 12% area have been with us for a long time. Now, there are, of course, factors other than simply return on equity that will impact your real investment results. And Buffett lays those out for us. He says, your future results will be governed by three variables: the relationship between book value and market value, the tax rate, and the inflation rate. So firstly, let's talk about the relationship between book value and market value. As you might expect from a value investor like Buffett, he argues that paying lower prices is generally a better thing for your returns. He gives the example of if a stock sold at 150% of book value, and again, this is taking an American corporation earning that 12% return on equity, and he's arguing that basically half of the earnings are retained, half of them are paid out as dividends. So he says, if the stock sold at 150% of book value, the picture would change. The investor would receive the same $6 cash dividend, but it would now represent only a 4% return on his $150 cost. The book value of the business would still increase by 6% to $106, and the market value of the investor's holdings, valued consistently at 150% of book value, would similarly increase by 6% to $159. But the investor's total return, i.e. from appreciation plus dividends, would only be 10% versus the underlying 12% earned by the business. When the investor buys in below book value, the process is reversed. For example, if the stock sells at 80% of book value, the same earnings and payout assumptions would yield 7.5% from dividends, $6 on an $80 purchase price, and 6% from appreciation, a total return of 13.5%. In other words, you would do better to buying at a discount rather than a premium, just as common sense would suggest. Next on the list, we have taxes and inflation. I won't speak too much to taxes because it'll depend on where you are in the world watching this video, and I'm sure that taxes have changed quite dramatically in the US since 1977. But effectively, Buffett was making the argument at the time that a 12% return on stocks pre-tax is probably equivalent to about a 7% post-tax return. So he argues that if you were to buy a 7% tax-exempt bond, that would be about the same result as a 12% pre-tax return from the average American corporation purchased at 1x book value. Moving finally to the impact of inflation on your real return, there's a section in here that says what widows don't notice. He says it makes no difference to a widow with her savings in a 5% passbook account whether she pays 100% tax on her interest income during a period of zero inflation or pays no income taxes during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Any money she spends comes right out of capital. She would find it outrageous, a 120% income tax, but doesn't seem to notice that 6% inflation is the economic equivalent. If my inflation assumption is close to correct, disappointing results will occur, not because the market falls, but in spite of the fact that the market rises. Now, one of the big transitions in his career that Buffett is famous for going through is this transition from buying into bad businesses priced exceptionally cheaply to buying better businesses and paying up a little for them, paying a fair price for a great business, in other words. And in terms of inflation, Buffett actually makes the argument that the bad business is actually far worse off than the good business when it comes to kind of getting through periods of inflation, because they need to retain a higher proportion of their earnings in this really low return on capital business in order to just sustain themselves. He says, logically, a company with historic and prospective high returns on equity capital should retain much or all of its earnings so that shareholders can earn premium returns on enhanced capital. Conversely, low returns on corporate equity would suggest a very high dividend payout so that owners could direct capital toward more attractive areas. When prices continually rise, the bad businesses must retain every nickel that it can, not because it is attractive as a repository for equity capital, but precisely because it is so unattractive. The low return businesses must follow a high retention policy if it wishes to continue operating in the future as it has in the past, and most entities, including businesses, do. It simply has no choice. For inflation acts as a gigantic corporate tapeworm. That tapeworm preemptively consumes its requisite daily diet of investment dollars, regardless of the health of the host organism. The less prosperous the enterprise, the greater the proportion of available sustenance claimed by the tapeworm. A business earning 8% or 10% on equity often has no leftovers for expansion, debt reduction, or real dividends. The tapeworm of inflation simply cleans the plate. So there you have some of my highlights, or I guess lowlights, because Buffett was fairly pessimistic in this article about how inflation swindles the equity investor. I think inflation is a pretty misunderstood topic when it comes to investing in businesses, which is exactly what you're doing when you invest in the stock market. And I think now is an important a time as ever to reread some of these articles from Buffett and understand exactly how inflation might impact some of the businesses in your portfolio. So I will leave the full article link down in the description below if you want to check it out. I would definitely recommend doing so. But that's really all I've got from this one. If you did enjoy it, be sure to hit like and also subscribe to the channel if you are new here, and I will see you in the next video. Cheers.